Hello dear CA final students, I hope your preparations are going at its best. Now in this video, we are going to discuss IND AS 116 leases. Very quickly, it's all the important questions also I will try to cover. So let's quickly get into leases. Starting with what is a lease contract. So lease is a contract between two parties, lessor and lessee, whereby lessor is the owner of the asset. The title owner of the asset is lessor, conveys ROU asset, right of use of asset, to lessee for an agreed period of time in return of agreed lease rentals. We already know this. Okay. Now, we need to study the accounting in the books of lessor and accounting in the books of lessee. We need to do the accounting in the books of lessor, accounting in the books of lessee. In the books of lessee, first we are going to do accounting in the books of lessee. In the books of lessee, at the inception date, what is inception date? Earlier date of commitment between both the parties and agreement. Earlier date of commitment and agreement is the inception date. At the inception date, lessee should identify whether the contract contains lease. At the inception date, the lessee should identify whether the contract contains lease. So how do I identify whether the contract contains lease, whether the contract in substance a lease contract? How do we identify? For that, there are four conditions. If all the four conditions are satisfied, we can say the contract contains lease. So what are the four conditions? There should be an identified asset. To constitute as a lease contract, in the agreement there should be an identified asset, which means if there is a land, it should be specified where it is located, how much area, what is the everything related to that land, all the information related to that specific land. If it is a car, which color, which variant, what is the number, everything should be, because it cannot be substituted. It should be an identified asset, and the customer should get substantially all the benefits from the asset during the lease term. Customer should get all the benefits from the asset during the lease term, and customer directs for what purpose and how the asset is being used. The full rights, right of use given means lessor does not have right. Who's having the right throughout the term, lease term? The customer, lessee. And the customer designs or operates the asset, or lessor can do it on behalf of customer. So here these 4 points should be identified, that then only it can be concluded that the contract contains lease. In short, lessor should not have substantive substitution rights. Okay, to constitute as lease, lessee has all the power. Lessee has the rights. There should be an identified asset. Lessor should not have substantive substitution rights. Okay, fine. So very important. Come on. What is the accounting in the books of lessee? In the books of lessee, first lessee should calculate lease liability. Lessee should compute lease liability. Lessee should compute lease liability. So lease liability is equal to present value of, lease liability is equal to present value of 1, 2, 3, 4, 5. You should number and study 1, 2, 3, 4, 5, 1. Fixed lease payments or in substance fixed lease payments. Fixed lease payments or in substance fixed lease payments. What do you mean by in substance fixed lease payments? So here you are using a building and the rent is agreed like this. Annual rent of 50,000. Annual rent is 50,000. If the shop is, or if the building is used for more than 8 hours a day, the rent will increase to 10 lakhs. Additional 9,50,000 is payable in a year. And we have inquired with lessee customer. The shop will be opened for 10 hours a day. So can I say 50,000 is fixed and 9,50,000 is contingent? I cannot say because it is confirmed, definite payment, right? Every day 10 hours if you work. So is it contingent? It is confirmed that you should pay 10 lakhs. It is confirmed that you should pay 10 lakhs every year. Yes or no? So this is what called as, this is fixed and this is contingent. We'll say no, this is not contingent. This 9 lakh 50 will be called as in substance fixed. Okay, legally it is contingent, but it is in substance fixed. Are you understanding? So if there is a doubt, you will ask me. Hopefully it is clear. So you need to check whether contingent is actually contingent or in substance fixed. So you should take for lease liability calculation, fixed lease payments, in substance fixed, then variable lease payments linked to rate or index. So first year 10 lakh, second year 10 lakh 20, third year 10 lakh 40. By rate, if there is a increase, you take it. Variable, that should be considered. Index, consumer price index, retail price index, inflation index. If there is an increase in the inflation, that will be changed. So here if it is given 1 lakh is the lease rentals. Okay, and it will increase with consumer price index. Now after 2 years, they are telling consumer price index was 125 at the starting. Now it has become 225. Then what you should do? 1 lakh divided by 1 lakh is the lease rental when the consumer price index was 125. When consumer price index is 225, 1 lakh divided by 125 into 225, that is, now the rent should become 1 lakh 80. Manasilayo? Yes. Yes. So if it is increasing by consumer price index, that should be considered. Okay, that is clear. Guaranteed residual value. Difference between residual value guaranteed in the contract and expected residual value. Yeah. See, every contract will have a guaranteed residual value. See, I am giving my laptop for rental basis for 2 years. They are telling when you return, that laptop should have a minimum value of 80,000. Mentioned in the contract. This is the guaranteed residual value. 80,000 should be the value you should return. When I return, the value will be only 60,000. You are supposed to pay 20,000. Cash outflow is expected. 20,000 cash outflow is expected. So 20,000 also should be discounted. Okay. Then 4. Termination option price or purchase option price likely to be exercised. If you are sure that lease contracts are non-cancelable contracts. What do you mean by non-cancelable? If you cancel, you need to pay penalty. If you cancel, you need to pay penalty. If you cancel, you need to pay penalty. So non-cancelable leases, definitely there will be termination penalties. Do you think it's a 5-year contract? Do you think it will be cancelled in between? Yes. Then you need to pay penalty also. Yes. So you take that termination option price. Now, most of the lease contracts have purchase option for the lessee. If there is a purchase option likely to be exercised, you take that purchase option price also. Okay. Fixed lease payments, variable lease payments. But when you take variable lease payments, do not take contingent lease rentals. Take guaranteed residual value. Take termination option price or purchase option price, and don't forget to deduct lease incentives. Okay, that is reimbursements by lessor to lessee is there, that is to be done. So 5 points you should number and study. Okay. Now what is the journal entry initially less in the books of lessee? ROU, right of use asset debit, which I have to show separately in my balance sheet. Right of use asset debit. 2. Lease liability. Lease liability is that 1 plus 2 plus 3 plus 4 plus 5 alla lease incentives is to be deducted. If you have paid a lease rental in advance, it is not lease liability. You already paid rentals in advance. Or if there is an initial direct cost incurred, you incurred some expenses for the asset, then it is to be added to ROU asset. It is not a lease liability, it is ROU asset. Then provision for dismantling, decommissioning, restoration of site expenses will be there. If you have taken a building on lease and you constructed a compound wall which you need to dismantle after 2 years and restore the site, then provision for dismantling also will be added. Okay, fine. Now, what is lease period? Because lease period is very important. Because lease payments during the lease period is what? Lease rentals, discounting, lease liability. So, how much will be taken as the lease period? What will be taken as the lease period? Lease period is the non-cancelable period. Agreed lease period plus renewal. If you estimate that the renewal period gives you some significant economic incentive. My standard is using that term. If renewal is expected to give some significant economic incentive, consider the renewal period also. So lease period is non-cancelable period. Upon cancellation, there will be termination penalty. Okay. Now for discounting, lease liability is discounted. Yeah, correct. Present value of lease payments. So will you take IBR or IRR? For lease calculations, we always use IRR. So IND AS 115 says I use IBR 115. Significant finance component we use IBR. But for lease liability discounting, we should use IRR. Now, if IRR is not available, then what is the subsequent accounting? So ROU asset, lease liability, subsequent accounting will be there for ROU asset, lease liability and provision for dismantling. ROU asset, you all know that ROU asset will be depreciated over the lease term in the pattern of future economic benefits. That's it. Yeah. What about lease liability? Unwinded, prepare amortization table as per our IND AS, like what we are doing in IND AS 109 financial instruments. Easy. If there is a provision for dismantling restoration, that also will be unwinded. That also will be unwinded. So that takes care of subsequent accounting. Now, two areas in lessee's books, just two more areas with that this accounting in the books of lessee can be closed by trying one question. Remeasurement of lease liability. When there is change in lease payments or guaranteed residual value. When there is change in lease payments, maybe out of change in inflation index. Because of inflation index, there can be change in the estimated lease payments, which we have calculated for lease liability. Guaranteed residual value. Initially, I thought 80,000 is the guaranteed value. 60,000 will be the expected residual value. I need to pay 20. But later, 80,000. I think the expected residual value will be only 20. Then the cash outflow will change to 60,000. Yes or no? Cash outflow will change to 60,000. So there is no amendment. No amendment in existing contract. But your estimations have changed. Then what you should do? Compute revised lease liability using original IRR. Original lease liability you computed using which IRR? Use the same IRR for calculating the revised lease liability. Okay. Now, when there is change in the lease term or when there is change in the purchase option, maybe you included renewal period also. Maybe you included or excluded renewal period. Or maybe you included termination option or excluded termination option, which will be having some impact in the lease term. Am I correct? Yes. purchase option. Initially you thought you will exercise purchase option, then you subsequently decided not to exercise purchase option. Because of this purchase option exercise or not exercise, as a result there is a change. Compute revised lease liability using revised IRR. Compute revised lease liability using revised IRR. Revised lease liability using revised IRR. Are you clear? Hmm? Yes. Okay. So there are two areas. First one, initially you started off. Subsequently, there is a change. Change out of remeasurement, re-estimation, there is a change. Or change out of amendment. There can be change out of amendment. Contract has changed. Contract itself has changed. So here there is no amendment, but here there is amendment. But if there is amendment in any of the terms, if there is amendment in any of the terms, compute revised lease liability using, if there is an amendment, always revised IRR. Difference between book value and revised lease liability will be adjusted in ROU asset. Will be adjusted against ROU asset. Okay. If distinct ROU assets are added at standalone price, distinct ROU assets are added at standalone price, then modification will be treated as a new and separate lease. What? Just now or yesterday we have studied IND AS 115, just finished IND AS 115. Yeah, there is contract modification. Yes or no? When there is a contract modification, we'll treat it as new and separate contract, or sometimes we'll not treat it as new and we go for cumulative catch-up method. When do we treat it as new contract? When distinct performance obligations are added at SSP, standalone selling price, then it is a new and separate contract, or else cumulative catch-up basis. Same thing. What is given here? If distinct ROU assets are added at standalone price, then the modification should be treated as new and separate lease. It will be treated as new and separate lease. Okay. Okay. Now, so always this is my step. Step 1, compute book value of lease liability, revise lease liability, pass journal entry. But if there is decrease in scope out of modification, if there is reduction in ROU asset, or out of modification, if there is reduction in lease term, out of modification, there is reduction in ROU asset, out of modification, there is reduction in lease term or ROU asset, then proportionate decline out of decrease, that is treated as partial termination. Partial termination of, it is treated as, if there is reduction, it is treated as partial termination of lease. Gain or loss will be transferred to P&L. Lease liability to ROU asset when there is a reduction in the ROU asset or reduction in the term, or else any change in the value of lease liability is adjusted to ROU asset. Okay, we'll try a question. We can read this. Lessee enters into a 10-year lease for 2000 square meters of office space. Okay. The annual lease payments are 1 lakh payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Lessor's incremental borrowing rate at the commencement date is 6%. Okay, so 10-year lease, 2000 square meters of office space, 1 lakh payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. IRR. cannot be readily determined, lessee's IBR is used. 6% rate is used. Okay, IBR is used. At the beginning of year 6, lessee and lessor agree to amend the original lease. So, amendment. When you see the amendment, we call it as lease modification. Okay. As per the amendment, we included an additional 1500 square meters of space in the same building starting from, so additional ROU. Additional ROU assets. Okay. Now reduce the lease term from 10 years to 8 years. The annual, so 10 years to 8 years, already 5 years completed. So remaining 5 years were there. From that remaining 5 years, you reduce to remaining 3 years. From remaining 5, you reduce to remaining 3. Okay. And the annual fixed payment for 3,500 square meters is 1,50,000 payable at the end of each year. Lessee's IBR is 7% per annum. Consideration for increase in the scope of 1,500 square meters is not commensurate with the standalone price. Additional ROU asset is not commensurate with the standalone price. What does that mean? Additional ROU asset. Additional ROU assets are added, right? That does not commensurate with, there is no SSP, which means it will not be treated as a new or separate lease. It will be treated as adjustment in the existing lease arrangement. Okay. Yes. Lease does not account for the increase in scope that adds the right to use an additional 1,500 as separate lease. We are not treating it as a separate lease. How should the said modification be accounted for? How should the said modification be accounted for? How should the said modification be accounted for? So there are two modifications. What are the two modifications? One is addition of 1,500 square meters. Second one is reduction of lease term. How this should be accounted? See, 1, 2, 3, 4. You should remember whenever there is modification with the reduction, there are 4 steps. It's a 4-step approach. What are the 4 steps here? Okay. Step number 1. If you want to try, we'll just have a look. What is my step number 1? Your step number 1 is book value of lease liability. Book value of lease liability. You have two methods in calculating the book value of lease liability. What are the two methods? Already it was 1 lakh. Okay, already it was 1 lakh. Payable for how many years? 10 years. At 6%. So 1 lakh into annuity factor at 6% for 10 years. When you do, you will get the opening lease liability. Yes or no? You will get the opening lease liability, but 5 years expired. So you prepare the amortization table, unwind 6% repayment. You prepare the amortization table and arrive what is the book value of lease liability. Or see, in the exam hall, considering the time constraints, what you can do? Present value of remaining cash flows. So that is 1 lakh into annuity factor at 6% for 5 years you can do. Then also you will get, because the closing balance in the amortization table is always equal to present value of remaining cash flows. Yeah. So we calculated 1 lakh into annuity factor at 6% for 5 years. Your lease liability as 4 lakh 21,200. Book value of lease liability is 4,21,200. Okay. 4,21,200. Okay. Now book value of ROU asset. Book value of ROU asset. How do I calculate the book value of ROU asset? So study This is required only when there is a reduction. This step is required only when there is a reduction. This step is required only when there is a reduction. This step is required only when there is a reduction. Book value of ROU asset. How do I calculate? Calculate starting ROU asset, initial ROU asset and then depreciate. But how do I calculate starting ROU asset? 1 lakh into annuity factor at 6% for 10 years. This is the opening lease liability, which is equal to opening ROU asset. Opening lease liability is the opening ROU asset. Okay, this is the opening lease liability, opening ROU asset. Then, now you depreciate. The asset will be depreciated over 10 years. So 5 years expired. So 7,36,000 into 5 by 10 depreciated. So balance 5 by 10 is the value of asset. So 3,68,000 is the value of asset. Yes or no? Now we have lease liability 4,21,200. ROU asset 3,68,000. Now we should find out, is there a decline, a reduction in the ROU asset or reduction in the lease term? There is reduction in lease term, not reduction in ROU asset. If ROU asset was reduced, proportionately we would have reduced, but there is reduction in lease term. What is the reduction here? So here there is proportionate reduction in lease term. Lease term reduced from remaining 5 years to 3 years. So lease liability to be reduced is, listen, this is what done in the study material. Lease liability required is only 1 lakh into annuity factor at 6% for 3 years. This is only what required. Yes or no? 1 divided by 1.061. 1, 2, 3. 2.673. 2.673. 1 lakh into 2.673. 2,67,300 was the lease liability required. Yes. So, but book value of lease liability is 4,21,200. So, lease liability to be cancelled is 153,900. Yes or no? Lease liability to be debited is 153,900. But in class, what we would have done is lease. This is how I would have done in class. 1 lakh first year, എല്ലാം same അല്ലേ? First year present value, second year present value, third year present value. We don't require the last 2 years present value. So I took the total of 7,921 plus 0.7472, 1.539. 1,53,900. 1 lakh into 1.539. So lease liability to be debited is 1,53,900. We have taken 900. Okay. So ROU asset to be reduced. ROU asset to be reduced is 2 by 5 you write off now. Useful life reduced, you write off 2 by 5. So partial reduction, the entry you should pass is lease liability debit 1,53,900 to ROU asset to P&L 6,700. Are you okay with this? Is there anything that I need to explain once more? Clear? Okay. So now in the step 1, 2 and 3, We have done the accounting of what? Step 1, 2, 3. We have done the accounting of reduction. We have done the accounting of reduction. Now there is an increase also. Yeah, there is an increase. So here, revised lease liability. Now we'll calculate step number 4. What is the revised lease liability? What is the revised lease liability? Our lease liability has increased to 1,50,000. Yes, revised lease liability has increased to 1,50,000. Lease liability has increased to 1,50,000 for 3 years. And the revised rate is 7%. So revised lease liability is 1,50,000 into annuity factor at 7% for 3 years. It is 3,93,600. ശരിയാണോ? 1,50,000 annuity factor I multiplied. So it is 3,93,600 is the present value of lease liability, revised lease liability. Are you okay? Book value was 4,21,200. My original lease liability, of which 1,53,900 reduced. So 4,21,200 minus 153,900, 267,300. 267,300. Okay. 267,300. So increase in lease liability is 126,300. So this is my next entry. Lease liability increased by this amount. To that extent, ROU asset also will be increased. So whenever we calculate lease calculations we do, lease in the books of lessee, when we calculate lease liability, always be clear whether lease payments are at the end of the year or lease payments are at the beginning of the year. Always ensure whether the lease payments are at the beginning of the year or lease payments are at the end. Lease payments are at the beginning or whether the lease payments are at the end. Okay. So this is because this question came, I just wanted to discuss this one quickly. This is again remeasurement. This is remeasurement. What is the rule as per remeasurement? There is no amendment, but if there is a remeasurement, if the remeasurement is out of change in lease payments or guaranteed residual value, calculate the revised lease liability using original IRR. In the other case, term changed or purchase option changed, it should be calculated using revised. So here this is a question. Actually, this is illustration 32 in our study material. Then illustration 32 in the study material, and this has come in December 21 attempt for 8 marks. So what is this question? Quickly. Entity W entered into a contract for lease of retail store with entity J on 1st January 2011. So contract date is 1st January 11. The initial term is 5 years with a renewal option of further 3 years. So initial term 5 years, you can, if you want, you can renew after for 3 more years. The annual payments for initial term is 1 lakh and renewal term, if you are exercising, it is 1,10,000. The annual payment will increase based on the annual increase in CPI, consumer price index, at the end of the preceding year. For example, payment due on 1st January 12 will be based on CPI available on 31st December 2011. So here there is a hint that the payment is due. Lease payments are due on 1st January. Hint. There it is not explicitly given, but there is a hint. So always you check the question whether there is a hint that what will be the payment, because when will be the payment, because accordingly my lease liability can go wrong. Yes. Entity W's IBR as set the inception date and 1st January 14 is 5% and 60 alla, sorry, 6% respectively. And CPI at the beginning 120 and after 4 years it is 125. At the lease commencement date, entity W did not have a significant economic incentive to exercise the renewal option. Entity W did not have a significant economic incentive to renew the option. So we'll take the lease term as how many years? Initially, they have taken the lease term as 5 years. In 2014, W installed a unique lease improvements in the retail store with an estimated 5-year economic life. Entity W determined that it would only recover the cost of the improvement if it exercises the renewal option, creates a significant economic incentive. So now there is a significant economic incentive and entity W required to remeasure the lease in the first quarter of 2014. Remeasure in the first quarter of 2014. So what? How this will be accounted? So this is remeasurement. There is no amendment. What are the accounting treatments required? If there is no reduction, if it is not modification reduction, we can do this in step number 1, step number 2, entry. What is step number 1? Book value of lease liability. What is step number 2? Revised value of lease liability. What is the entry? Entry for the difference. What is the book value of lease liability then? Okay, book value, we started on 1st January 2011. So 1st January 2011, 12, 13. 3 years already paid. So 2 more years. 2 more years. One is due now. And one is due after 1 year. So what is the rate initially? 5%. Divided by 1.0. 0.95238. 0.95238. 5%. 0.9524. So 9524. 95,240 plus 1 lakh. 1,95,240. The revised value of lease liability will be? Do you have an idea what will be the revised lease liability balances? Lease term has changed and lease payments also changed. So which rate is to be used? There is change in lease term and also there is change in lease liability. Because lease payments also will change. Lease term and lease payments both changed. Which rate is to be used? 5 or 6? Of course 6. Term changed 6%. What are the lease payments? Lease payments year 4, year 5, year 6, 7, 8. Year 4 it is CPI has changed from 120 to 125. So it is 1 lakh divided by 120 into 125. Year 4 it is 1 lakh 4. My revised payment is this. Year 5 also 1 lakh 4, 167. And year 6, 7, 8, 1 lakh 10,000 divided by 120 into 125. 1 lakh 14,583. Discount using 6%. So year 4 it is 1 divided by 1.06 9434 0.9434. But ma'am that was in the existing That was that X was in the extension was already there in the original contract. Remeasurement, but term changed. Original contract, there is no modification, but term changed means even though it is there in the original contract, term changed means you should calculate revised liability using revised rate. Term purchase option changed means revised rate is to be used. Okay. Amendment always revised. Remeasurement term changed, revised rate. Okay. So 1,14,000. 1 divided by 1.061 1.25.2.5217. 4,91,382. 4,91,382. Original was 195,240. 491,382. Did you understand this? So 195,240 increases 296,142. Exact alla 296,120 ആണ് എൻ്റെ ഇവിടെ ക്ലാസ്സിൽ വർക്ക്ഔട്ട് ചെയ്ത് പോകുന്നത്. That's okay. So it is ROU asset to lease liability. 296 something. Okay. So remeasurement, always remeasurement you should go for original IRR. No, remeasurement only payment amount changed, lease payment changed, GRV changed, then original. Or else you should go for revised. Term and purchase option changed, revised. Lease modification, always revised. Okay. Okay, hopefully okay. Now, in the books of lessee, always lessee should apply IND AS 116. Should always lessee applies IND AS 116 to account for lease contracts. There are two exceptions. If in case of short-term leases, where the lease period including renewal period is less than, consider renewal period also, lease period including renewal period is less than 12 months, then it is no need to require the application of IND AS 116. Okay. And if the lease term is 5 years, but you are leasing a low value item, if you are leasing out a low value item, if it is a 5-year lease but you are leasing out a low value item, leasing out a low value item, that is like an office furniture, mobile phones, tablets. Okay, so here they are very, very clear. If I am having a machinery and that machinery is not a low value item, but this machinery if break down to different parts, it can be low value item. Part number 1 is low value, part number 2 is low value, part number 3, 4, 5, these are low value items. Okay, so can I consider all this breakdown parts as low value item? So low value item, to avoid confusion, they have defined what is a low value item. What is a low value item? You should learn these lines. What is a low value item? And low value item, an item can be considered, if this calculator can be considered as a low value item, if this is 200 rupees calculator, the entity can get the benefit of the underlying assets its own or together with resources which are already owned by the entity. This can be a low value. If I get the benefit of this, it's on. If this calculator giving independent benefits, of course. Is it connected to other asset and getting the benefit? No. I'm getting independent benefit. The entity can get the benefit of underlying asset, it's on, or together with other assets which are already owned by the entity. Which means if there is a furniture, in that furniture, I already own this part 2, part 3, part 4, part 5, I already own. I already had this part 1 also. But now part 1 is not working. So I have taken ROU of this part 1. Then this part 1 can be considered as low value. If I already own the other items. Are you clear? If a part I have taken as low value, then all other parts are owning by me, then that part 1 can still be considered as low value item. Manasilayo? Yes. Now, so low value item, the entity can get benefit of its own or together with other resources which are already owned by the entity. Now, the various underlying ROU assets are not interdependent or interrelated. All these ROU items here, what if I take 1, 2, 3, 4, 5? The step addition, all this low value items should not be this. If I am claiming this as low value exemption, this is 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 low value exemption. Then I have 5 ROU assets for which I am claiming low value exemption, and this lease is not applicable. Now the standard says, sorry, this ROU assets should not be, this low value ROU items should not be interrelated or interconnected. The underlying assets should not be interconnected or interrelated or interdependent. അതായത് I cannot claim low value item exemption for many items which is connected each other and together it will form a high value item. That is not possible. മനസ്സിലായോ? Should I explain anything once more? The various underlying assets are not interdependent or interrelated. Clear? So low value exemption you can get if you say that is low value, then you can get the benefit from the asset it's owned or together with other resources which are already owned by the entity. Okay. Now, so there are exceptions. All leases cannot fall under IND AS 116 purview. You can get exemption. Fine. Now, if there are multiple components in a lease arrangement, should I separate? Now, I didn't understand that. That is in a contract where I am taking a building on lease. I am taking a building on lease. In that building, there is furniture. There is electrical equipments. So, Madhi. The question is, and there is a land, of course. So there is a land, 5 cents. There is a building. There is furniture and electrical equipments together which I am paying 5 lakhs lease rentals per annum. Do I need to split it as ROU land, ROU furniture, ROU building, ROU electrical equipments? Do I need to split? Separation of lease components are compulsory. What? Yes. Separation of lease components are compulsory if both the conditions are satisfied. If 2 conditions are satisfied, separation of lease components, various lease components in a like a separate performance obligation. Is separation of performance obligation compulsory? Yes. Similarly, separation of lease components are compulsory provided 2 conditions are satisfied. What are the 2 conditions? The entity can get the benefit of underlying asset its own. If will I get the benefit of land as land its own benefit? Will I get building, furniture, electrical equipments? Ayyo, inki manasilayilla. Can you please explain? So, Land you cannot get the benefit separately, but here if in that land already a building is constructed, then you will not get the land benefit separately. Now what is this point I'll explain. In this building, if there are furnitures, can you take this furniture out and put it in another building and use? Can you take this furniture out and put in other building and use? Yes, if it is possible. What? That is, the entity can get the benefit of underlying asset it's on. Can you get independent benefit from furniture? Yes. Then, and it is not highly interdependent or interrelated. If it is already attached to this building, ROU asset like already to the ROU building, if it is already attached, you cannot take it out. But it can be taken out. I can get independent benefit of furniture. Okay, then you need to separate ROU furniture. Are you getting this? Then you need to separate and show it as ROU furniture. Electrical equipments, there are ACs, there are fans, there are other electrical equipments. Can you take it out and you get the benefit independently? Yes. If that is the case, you should separate. But sometimes if it is centralized AC, in your study material HVAC system, heating, ventilation, air conditioning system, which is centralized. If it is centralized AC, centralized heating, ventilation, will you be able to separate? No, you cannot take it out. You won't get independent benefit. So in that case, separation is not required because it is highly interrelated or interdependent. Our building like അത് already attached ആണ്. Are you clear? So is separation of lease components compulsory? The separation of lease components compulsory? Yes, yes, yes. It is mandatory to separate lease components. Lease rentals are to be allocated provided two conditions. Yes, two conditions are satisfied. What are the two conditions? The lessee can get the benefit of underlying asset its own, and the underlying assets in the contract is not highly interrelated or interdependent. If both conditions are satisfied, it is to be separated. Okay. So how it will be separated? The lease liability and ROU asset should be recognized separately. The allocation is based on standalone. If I am taking only furniture, what would have been the value? If I taking only building, what would have been the value? You calculate that. Or in the question they will give from the exam point of view. Okay. Okay. Fine. Now, is it required to separate lease and non-lease components? Optional. It is optional that you can take practical expedient not to separate. Lessee can take practical expedient not to separate. I'm not clear. What is this non-lease component? It is not clear. Okay, I'm taking a building for rental purpose. It's a flat. So I'm paying 25,000 rupees lease rentals. This includes maintenance. So 23,000 towards flat and 2,000 towards maintenance. So can I take 25,000 as lease liability or 23,000 as lease liability? It is optional. It is optional. You may take practical expedient and don't separate. You take entire 25,000 as lease liability. Or if you don't want to apply practical expedient, take 23,000 in lease liability and show 2,000 as maintenance expense account separately. You account it as maintenance expense and account it separately. Did you understand that? Once more. Okay. So that is ഞാനൊരു ക്വസ്റ്റ്യൻ എടുക്കട്ടെ. ഒരു ക്വസ്റ്റ്യൻ I will take, I mean, just for more clarity. Not an illustrate, no, it's not it to practice question. Practice question. Yes. Everyone, listen. This was already there in our study material, but now we will discuss. Just a moment. Entity X. This question has not come for exam. It can come. This is our practice questions. Question number 1. Entity X, lessee, entered into a lease agreement with entity Y. So there is a lessee, there is a lessor to lease an entire floor of a shopping mall for a period of 9 years. Okay. The annual lease rent is 70,000. To carry out the operation smoothly, entity X simultaneously entered into another agreement, facilities agreement, with entity Y for using other facilities owned by Y such as passenger lift, DG sets, power supply infrastructure, parking space, etc. Listen, I've taken one floor of a building. One floor fully I've taken. Yes. Okay. In that one floor, I'm paying 70,000 as my rent. Now to carry out the operation smoothly, because I've taken one floor, one shopping mall, one floor I've taken. So to carry out the operations, I've also entered into another agreement to use passenger lift, DG sets, power supply infrastructure, parking space, etc. For which I am paying service charges. I am paying 1 lakh, which means how much I am paying together? I am paying 1,70,000. Yes or no? Yes. Yes. As per the agreement, the ownership of facilities shall remain with entity Y. Entity Y is the lessor. From lessor, I'm using various facilities and the ownership is with Y. Lessee's IBR is 10%. The facilities agreement clearly specifies that it shall be coexistent and coterminous with the lease agreement. The facility agreement shall stand terminated automatically on termination or expiry of lease agreement. What is this? What does this mean? This is coexistent and coterminous with lease agreement means if because you are taking one floor on rental basis, we are giving this facilities. If you're not taking that floor on rental basis, do you need the passenger lift? Do you need this DG sets? Do you need this other infrastructure, parking? All this, is it required? No, you have a lease agreement. That is the reason you are going for this facilities agreement. Second contract terminates with the lease agreement. Now, entity X has assessed that the standalone price of lease, if I have taken only lease, then it is 1,20,000 per year and standalone price of facilities agreement is 80,000. Entity X has not elected to apply practical experience. Here, my IND AS 116 is giving me two options. You may treat entire 1,70,000 as lease payment. Lease liability computation, you may take entire 1,70,000. മനസ്സിലാവുന്നുണ്ടോ? Are you understanding? You may take the entire 1,70,000 as lease payments. You can apply practical experience. So one is lease, the other one is non-lease. In 1 lakh when I pay, is there any identifiable asset in the contract? I pay 1 lakh. Is there any identifiable asset? No. Identifiable asset, I already made a lease agreement. 1 lakh is not for identifiable asset. 1 lakh is for facilities. 1 lakh is for facilities, non-lease components, services. Exactly. So here, but the company has decided not to apply practical expedient, means they decided not to combine this 1,70,000. They want to split an account. They want to record lease liability separately. They want to record service payment separately. Okay. So if it separates non-lease components from lease components, so then how this will be accounted? So this is what I was saying. If the payment is towards assets, if 1,70,000 is for both assets, then you need to separate. Compulsory that separation of lease components are separation of lease components are compulsory, but separation of non-lease components are not compulsory. Entity can go for practical expedient, but if the entity does not want that practical expedient, it should split. So how this will be accounted? How this will be accounted? Okay. Total payment is 1,70,000. You know, 70 for lease agreement and 1 lakh for the other. But that is not the way you should do. 1,70,000 you should divide in the ratio of standalone prices. So 120 is to 80. 170 into 120 divided by 200. 102, 1,02,000 should form part of lease liability. And balance 68,000 should form part of maintenance. Are you understanding this? So how much is your lease liability? 1,02,000 into annuity factor rate. Only IBR is given. Okay. For 9 years. Is there a clue it is paid at the end? Yeah, payable at the year end. So I'll calculate. 1 divided by 1.10. 1, 2, 3, 4, 5, 6, 7, 8, 9. 5.759. How much it is coming to? 5.759 into 1,02,000. 5,87,418 ആണോ? 5,87,420. Okay. So lease liability. My first entry will be ROU asset to lease liability. Okay. Then first entry is this. Second entry, interest to lease liability. How much is interest to lease liability? 587,420 into 10%. 58,742. Then third entry, lease liability 1,02,000. Maintenance expense 68,000. To bank 1,70,000. Maintenance expense will be charged to P&L. Just be clear with the entries. Lease liability 1,02,000. Maintenance expense 68,000. Okay. To bank. So lease liability 1,02,000. Maintenance expense or slash P&L. Maintenance expense slash P&L to bank 1,70,000. Manaslayo. This is how it will be accounted if it is separated. Clear. So we'll do this question number 2 also. We'll try this question number 2. Question number 2 also we'll try now. What is this question number 2? Entity X is an Indian entity whose functional currency is Indian rupee. Entity X is an Indian entity. Functional currency is Indian rupee. It has taken a plant on lease from entity Y for 5 years to use its manufacturing processes, for which it has to pay annual rentals 10,000 every year. On the commencement date, exchange rate was $1 is equal to 68. Average rate is 69. At the end of year 1, and exchange rate 70. At the end of year 1, exchange rate is 70. Incremental borrowing rate is 5%. How will ROU asset and lease liability recorded initially at the end of the first year? It can be a 5 marks or 6 marks question. What is my first step? Entity X, Indian entity, it takes a plant on lease. Lease liability is 10,000. So 10,000 into how many years? 5 years. So annuity factor at 5% for 5 years. This will be converted using 68. 1, 2, 3, 4, 5. 4.329. My first entry is ROU asset to lease. Amount തെറ്റിപ്പോയ. 300 rupees difference. That's fine. 300 rupees difference. That's okay. Now to prepare amortization table. Amortization table. This is the rule that I want you to remember. Amortization table should be prepared using dollars. Should be prepared in dollars. It should be prepared in dollars, which means you should take 43,290, unwind at 10%, 5%, 43 into 5%, 2165. I am taking 2165, repay 10,000, closing 43,290 plus 2165 minus 10,000, 35,455. So 1 year they are asking. For interest, what is the entry? Interest to lease liability 2165 into average rate. Yes or no? Interest should be, income should be converted using average rate. Yes, yes. 2165 into 69. 1,49,385. 3. Lease liability to bank. 10,000 into, at the time of payment it is 70. Now we should find out opening 29,43,720. Then lease liability increased 1,49,385. You repaid 7 lakhs. Closing balance is standing at 23,93,105. 23,93,105. What is the required closing liability? Required closing liability is 35,455 into 70. 35,455 into 70. 24 lakh 81 850. 24 lakh 81 850. 88,745. For 88,745, I should pass the entry. Exchange loss, P&L, or foreign exchange loss to lease liability. Because lease exchange rate has increased, there is a increase in the lease liability. So 88,745 increase. P&L to lease liability. So when foreign exchange is involved, first I should calculate in dollars, foreign currency, then I should convert and pass the journal entry. Okay. Now let's go back to the theory. Let's go back to theory. What theory? So in the books of lessee, we can say in the books of lessee, this is what to be done. In the books of lessee, these are the areas. That is accounting in the lease liability computation, 5 points, ROU asset, that is lease liability plus any initial direct cost plus any provision for dismantling, then subsequent accounting. Okay. ROU asset will be depreciated, lease liability will be unwinded. What if there is remeasurement? If there is remeasurement, no amendment. Remeasurement, I remember payment changed, GRV changed, original EIR. If payment has not changed, if the term has changed and purchase option changed, revised. Then there is modification. Also, we'll go for revised. But modification, if there is decrease, proportionate decline, gain or loss will be transferred to P&L. Then exception. Separation. Lease components. Separation of non-lease components. These are the areas. If I sum up, these are the areas in the accounting in the books of lessee. Okay. Now, in the books of lessor. In the books of lessor. In the books of lessor. Accounting in the books of lessor. If you are going into the books of lessor, at the inception date, what was inception date? Contract date or the commitment date, whichever is earlier. Contract date or commitment date which is earlier. At the inception date, identify whether it is operating or finance lease. Identify whether it is an operating lease or finance lease. Okay. Now, how to identify the types of lease? How to identify the types of lease? If out of 5 conditions, if any one satisfied, it becomes. So there are 2 types of lease, finance lease, operating lease. And out of 5 conditions, if any one satisfied, it is finance lease. All failed, then it will be treated as all failed. It is operating lease. Okay. Now, what are the 5 conditions? As I said, you must be knowing this, but still. Significant risk and reward is transferred to lessee. Finance lease is like ownership is transferred kind of accounting we'll do. So risk and reward is with lessee during the lease term. Risk, all the risk is taken by lessee. Lessor has no responsibility. Then it is finance lease. Present value of MLP. What is MLP? Minimum lease payments. present value of MLP is at least equal to fair value of asset. Present value of MLP is at least equal to fair value of asset. Present value of MLP is at least equal to fair value of asset. Lease term covers major part of useful life of the asset. So MLP is at least covering fair value of asset. Okay. Then lease term covers major part of useful life of the asset. Major part the asset is with lessee. Lessee has paid substantially 90% of value of asset. Lessee, the lease has an option to purchase lessee has an option to purchase the asset at the end of the lease term. The lease has given an option to purchase the asset at the end of the lease term. Leased asset is a specialized asset which cannot be used by others without substantial modification. So if anyone satisfies it means that the asset, the risk reward control asset is more lying with lessee has having more control is what showing in all this 5 points. So if anyone satisfied, it is a finance lease. I'm not getting deep into this you have studied in intermediate level also. Okay, if anyone satisfied, it is a finance lease. If anyone satisfied, it is a finance lease. Apo understood. So what is the accounting in case of finance lease? Yeah, we'll discuss. What is the accounting in case of finance lease? We'll discuss. But before that, land lease. Our study material says, not study material, in DAS 116 says, land lease is always operating lease. It's an exception because land having indefinite useful life, you cannot say risk and reward is with lessee. Lessee, major part of useful life. There is no specific definite useful life. So there is no debate. Land lease is always treated as operating lease. Okay. So now question, what about land and building? And building is finance lease. Allocate lease rentals in the ratio of relative fair values. If only building, what would have been the lease rentals? Accordingly, you allocate. Land lease is operating lease. You take building lease as finance lease accounting. Sharing. Now, what if building is finance lease but allocation is not possible? Lease rentals cannot be apportioned. Then entire lease you treat it as finance lease. Okay. So land lease is always treated as operating lease. If land and building lease is operating lease, good. But building is finance lease, therefore building apportion and do finance lease. But apportionment is not possible, cannot be allocated. Standalone selling price is not available. If that is the case, you do one thing. Both land and building lease, you treat it as finance lease. Okay. So what is the accounting of finance lease? What is the accounting of finance lease? Okay. So accounting in the books of lessor. In case of finance lease, step number 1. Always study it as steps. Step number 1 is compute MLP. First of all, I don't know what is MLP. MLP. So first we need to study this points. What is MLP? What is gross investment in lease? What is net investment in lease? What is unearned finance income? Because throughout we'll see these points. What is MLP? Promised payments in a contract. In a contract, what are the payments which are promised to pay by the lessee to lessor? What are the promised payments? Only 2 promised payments are there. One is lease rentals. The other one is guaranteed residual value. I'm guaranteeing. The name itself is guaranteed residual value, which means we have guaranteed. Okay. So lease rentals and guaranteed residual values are guaranteed. Therefore, these are the promised payments in a contract. Okay. So that is what called as MLP. Minimum lease payments. Minimum you need to pay that payment because it's already there in the contract. Okay. So I have an asset. From the asset, promised payments are called as MLP. But gross inflows, only MLP we can get from this asset. No. After the lease term also, you can get some amount from that asset. That is what called as unguaranteed residual value. Unguaranteed residual value can be any payment which is not guaranteed. That's it. So if in the question they are saying residual value expected is 5 lakhs, but residual value guaranteed is only 4 lakhs. So you will get a guaranteed value 4 lakhs, and extra if you can get, if you sell asset in 5 lakhs and minimum value of the asset is 5 lakhs, guaranteed is 4 lakhs. So this asset can be sold outside. Lessor can sell it outside and get an extra 1 lakh from this asset. Yes or no? Total residual value is 5 lakhs, of which 4 lakhs is only guaranteed. Balance 1 lakh you can get from outside. That is what called as unguaranteed residual value. Okay. മനസ്സിലായില്ലേ? Should I explain once more? UGRV. If I expect any other inflow which is not guaranteed, it is unguaranteed residual value. Okay. Now, gross investment means gross inflows from the asset. Gross inflows from the asset is equal to MLP plus UGRV. MLP plus UGRV. Okay. All inflows expected from the asset is MLP plus UGRV. Now, net investment in lease. Present value of present value of all inflows. Net investment is equal to present value of all inflows expected from this. Unearned finance income. Finance income. Present value of all inflows minus total value of inflows is the unearned finance income. So you should study this formula. Yes, I have studied. So MLP is equal to promised payments. Present value of MLP is needed for what calculation? Present value of MLP is needed to identify finance lease or operating lease. Present value of MLP is at least equal to the fair value of asset. Present value of MLP is at least equal to, that is 90% fair value of asset. Then it is finance lease conditions. One condition, finance lease. Then gross investment in lease means gross inflows. So MLP means not present value, MLP rather than present value plus UGRV. Net investment in lease means present value of gross investment in lease. Unearned finance income, unwinding interest income. Okay, difference GIL minus NIL. Okay, fine. Now, if you are a dealer lessor, manufacturer lessor, which means you are into leasing business. Your main operations, this is leasing business. If you are a company into leasing business, if you are an entity into leasing business, what will be the journal entry at the time of lease? You have given an asset on lease. What will be the entry? You are into leasing business. You have given an asset on lease. What will be the journal entry? Very, very important. Your journal entry will be net investment in lease debit or net investment in lease, that is lease receivable. Present value for all inflows. Net investment in lease debit. Okay, net investment in lease debit. 2. Asset. Lease receivable to asset. Asset will be credited at carrying value. Okay, gain or loss to P&L? No. You will record to revenue and debit cost of goods sold. Because if you are into leasing business, if it is finance lease, it is as good as sales. Okay. Sales to revenue. So, net investment in lease to asset to revenue. How much will be recognized as revenue? So, we are taking this net investment lease receivable fully. Can I recognize as revenue? No. To revenue, which standard is applicable? Revenue means which standard is applicable? 115 is applicable. Yes or no? IND AS 115. As per 115, only contractual incomes are considered as revenue. Yes or no? Only what incomes? Contractual. UGRV, is it a contractual income? UGRV. Lease receivable includes UGRV. Come on, are you all listening? Shraddhikyu. UGRV is also included in net investment. Yeah, present value of all inflows is net investment where UGRV is also included. So that cannot be considered as contractual income. Revenue, expected incomes are not included. So revenue present value of MLP. Are you clear? Yes. Which means we deducted UGRV from it. Similarly, cost of goods sold. Cost means how much can be shown as cost. Carrying value minus present value of UGRV, meaning UGRV is not permitted to enter in P&L. Either as income or as cost, UGRV is not permitted to enter into P&L. So, net investment lease balance sheet, you can show UGRV. Asset carrying value will be credited, but P&L, for calculation of P&L profits, you should not take UGRV. Only for net investment lease calculation, you can take UGRV, unguaranteed residual value. Shall we try a question? അപ്പോൾ നിങ്ങൾക്ക് കൂടുതൽ മനസ്സിലാവും. Entry, if not a dealer or manufacturer, just net investment lease to asset, gain or loss to statement of P&L. That is a illustration 38. Accounting in the books of lessor, which is not asked for exam yet. Shall we take that question and discuss? This is illustration 38 in our study material. A dealer lessor enters into a 10-year lease of equipment with lessee. The equipment is not specialized in nature and is expected to have alternate use to the lessor at the end of 10-year lease term. So what are they trying to say? There is a lease, okay. Equipment is not specialized, one condition failed, and is expected to have alternate use to lessor, okay. The lessor receives annual payments of 15,000 payable at the end of each year, okay. Lessor receives annual lease payments of 15,000. Lessor expects the residual value of the equipment to be 50,000 at the end of 10-year lease. So residual value expected by lessor is 50,000. Lessee provides a residual value guarantee that protects lessor from the first 30,000. Oh, against that 50,000. So what do you understand? That is 50,000 is the total residual value expected, of which 30,000 is guaranteed. So balance 20,000 is unguaranteed residual value. Okay. The equipment has an estimated remaining life of 15 years, carrying amount 1 lakh, and fair value is 1,11,000. The lease does not transfer ownership of the underlying asset to lessee at the end of the lease term or contain an option. So there is no buying option for the lessee. Another condition failed. Interest rate implicit in the lease is 10.078%. How should lessor account for the same in the books and past journal entries? This is the only question on lessor accounting in our study material. What is the accounting here? So what is my first step? At the inception date, lessor, okay, as per IND AS 116. At the inception date, lessor should identify whether it is finance lease or operating lease. So here, there is no information regarding this is a, the risk and reward has been transferred. Okay. Now, lease term is 10 years. Useful life, 15 years. So 10 by 15. 66.67%. But my standard says lease term covers major part of useful life of the asset. Major part is defined as how much percentage? 75. So condition failed. Okay. Present value of MLP that we'll calculate. Then there is no buying option. Yeah, that is true. It is not a specialized asset. That is true. All that conditions failed. Only one condition pending. What is that? Present value of MLP should be at least equal to the fair value of asset. Present value of MLP should be at least equal to fair value. Present value of MLP should be at least equal to fair value. Present value of MLP should be at least equal to fair value of asset. So here present value of MLP 15,000 into annuity factor at 10.078% for 10 years. MLP means lease payments and guaranteed residual value 30,000 into present value factor 10.08% at 10th year. So we'll calculate how much is the present value of MLP coming to 1,03,344. Present value of MLP is 1,03,344. So 1,03,344 divided by fair value. It is covering 93.1%. Therefore, the given lease arrangement is finance. മനസ്സിലായോ? First we identify it as finance lease. Then what is my next step? My next step is accounting. Finance lease accounting. So finance lease accounting, what is my first step? First you identify what is gross investment in lease. Finance lease accounting, what is your gross investment in lease? Gross investment in lease means 15,000 into 10, 1,50,000. Okay. GRV 30,000. UGRV 20,000. So gross investment in lease is 2 lakhs. Okay. So net investment in leases. Why should I do all this? Gross investment in leases MLP plus UGRV. So net investment in leases present value of MLP plus present value of UGRV. Present value of MLP you already know 1,03,344 plus 1 divided by 1.10078. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.3828. 20,000 into 0.3828. 7656 can be added. 20,000 into 0.3828. Yes or no? Anything to be explained? No, clear. So if you're doing NIL is equal to 1,03,344. Present value of MLP, we know it is 1,03,344. Plus present value of UGRV is 7656. 20,000 into 0.3828. So 1,03,344 plus exactly NIL comes to 1,11,000. What is the journal entry? What is the journal entry? Journal entry is NIL, lease receivable entry. Okay. NIL 1,11,000 to asset credited at carrying value. So gain of 11,000. That's not the way you should write. To revenue. That is 1,11,000 minus 7656. Cost of goods sold, carrying value of asset minus 7656, because 7656 is present value of UGRV, cannot enter into P&L. Are you understanding this? Is it okay? എന്തെങ്കിലും പ്രശ്നമുണ്ടോ? ഈ എൻട്രി ക്ലിയർ ആണോ? Eliminate present value of URP from both revenue and cost of goods sold. So what is my next step? So there is a lease receivable. Amortize. Opening 1,11,000, unwind at 10.78%. You received 15,000. Closing balance, unwind at 10.078%. Repayment 15,000. You do it. Lease receivable. Okay. So the journal entry will be net investment in lease to interest. Asset ആണ്, so interest. Bank to net investment in lease. It will be closed. Finally, you will get residual value and this will be closed. Last year you will get 15,000 residual value and total residual value 50,000. GRV and UGRV 50,000. Last year, if you take the repayment as 65,000, your table will be closed. What is the subsequent account of cost of goods sold? It is transferred to P&L. What is the subsequent accounting of asset? No entry. Transfer, balance sheet closed. Asset account is closed. Revenue transfer to P&L. So subsequent accounting only for NIL. What is the subsequent accounting for NIL? Lease receivable, unwinded, repayment. That's it. മനസ്സിലായോ? ഓക്കെ ആണോ? എന്തെങ്കിലും പറയണോ? This is accounting in the books of lessor. Accounting in the books of lessor. Now accounting of operating lease. Accounting of operating lease. What is the accounting if it is operating lease? Conditions field. So there is it is finally concluded as all the conditions failed in operating lease, then recognize asset in the books of lessor. If it is a land and building, then it is IND AS 40. Other assets held for rental purpose. So it is IND AS 16 or IND AS 40. Other assets held for rental purpose, it is IND AS 16 or else it is IND AS 40 in the books of lessor. Okay. Lessor will charge depreciation. Any initial direct cost incurred by lessor, any additional expense incurred for this lease will be capitalized and amortized in the, it will be capitalized and amortized in the ratio of lease income. Like IND AS 115, it is a contract acquisition cost. It cannot be
written off to P&L immediately in the contract income ratio, lease income. That contract income പോലെ തന്നെ lease income. That will be in that amortized in the ratio of lease income. Recognize lease rentals as income either on straight line basis or any other systematic basis which is appropriate. Okay. So, what do you mean by straight line basis or any other systematic basis if it is appropriate? This you have studied in your intermediate level, but you may be remembering, I don't know, if lease rentals are in this ratio 20,000, 30,000, 40,000. No other information is given, then what you should do? Lease rentals, operating lease 3 years, lease rentals 20, 30, 40. What you should do? And take the total. If nothing, if this is the systematic ratio given, then lessor will pass the entry bank to lease rental to P&L. If this is the systematic ratio, if they have given any other systematic basis, this is the systematic basis. If they mention bank to lease rental to P&L, bank to lease rental to P&L, bank to lease rental to P&L. But if this is not the systematic ratio or nothing is given, then I'll take the total as 90,000. Divided by 3, it is 30,000. What will be the journal entry to be passed? Bank account debit 20,000. Then, do you remember something called lease equalization account 10,000? Lease equalization account to lease rental 30,000. Amount to be charged to P&L is 30,000. Amount to be charged to P&L is 30,000. Straight line. Next year entry will be bank account debit 30,000. To lease rental 30,000. Lease rental to P&L. Last year bank account debit 40,000. To lease rentals only 30,000. And I'll close that lease equalization. Just to make it equal, I opened at 10,000. This you have studied in your inter level. But if you have in the final level, there is not even one question or such a basic area, so no question on this. If at all, in case if anything comes, you should have this background. Is that okay? Then any initial direct cost, that's okay. Then we have 2 more areas in lease. 2 more areas and the balance that questions I have to do anyway. So sublease and sale and leaseback. 2 more areas. Okay. What is sublease? Nothing great in sublease. Sublease, there is a original lease between lessee and lessor. That original lease will be here in after called as head lease. Original lease will be called as head lease. Okay. And now the lessee is not using the asset. So lessee can cancel the lease, but there will be termination penalty. There will be termination penalty. So lessee has gone for a sublease. Okay. So sublease means lessee has become an intermediate lessor. Lessee has become an intermediate lessor. Okay. So in the books of original lessee or intermediate lessor, in the books of original lessee or intermediate lessor, original lessee in this party. So there is no special accounting in the books of original lessor because lessor as usual will account. No special accounting in the books of sublessee. But in the books of lessee, who's the original lessee and intermediate lessor, 2 sets of accounting will come. So in the books of original lessee or intermediate lessor, as a party to the head lease, first party to the first contract, ROU was set to lease liability as usual. I'm a lessee. I don't know about sublease. I've taken the asset on lease. What will be the journal entry? ROU asset to lease liability. Huh. As a party to the sublease, if you are a party to the sublease, your character has changed to that of lessor. Yes or no? When you become a party to the sublease, your character has changed to a lessor. You were a lessee before, but now you have become a lessor. Yes or no? Yes. So in the books of lessor, identify at the inception date whether it is operating lease or whether it is finance lease. Operating lease. ROU asset is continued to be accounted. ROU asset cannot be cancelled. ROU asset will be continued. Operating lease asset will be appearing. Lease liability you cannot cancel as long as head lease is active. You cannot cancel that lease liability. It is an operating lease, right? So sublease income is recognized as income either on straight line basis or any other basis which is appropriate, any other systematic basis which is appropriate in statement of P&L. Operating lease sublease income will be recognized as income in straight line basis or any other appropriate basis in P&L. Okay. If it is finance lease, control is with the sublessee, then de-recognize ROU asset. Recognize net investment in lease receivable. So, net investment in lease debit to ROU asset. Now, can I ask you, should I record to revenue and debit cost of goods sold? Do I need to record this debit cost of goods sold and credit revenue? Should I pass this to revenue and debit cost of goods sold? Come on, anyone please reply. Reply. That is not required because a dealer lessor or manufacturer lessor only required to do this revenue and cost of goods sold. If I am into leasing business, can sublease become your business? മനസ്സിലാവണ്ടോ? Sublease നിങ്ങളുടെ business ആവോ? Only if you are into leasing business you do this. Sublease can never be your business. Okay. എനിക്കറിഞ്ഞൂടാ. നിങ്ങൾക്ക് എന്താണ് എല്ലാവരും മനസ്സിലായോ? What did I say? If you are a lessor who is into leasing business, then revenue from operations, leasing income should come. Cost of goods sold should come. Okay, don't credit one single amount in P&L. Instead, you should show revenue separately. You should show cost of goods sold separately. But sublease can never be your business. So sublease happens once in a while. I don't want the asset, then what I'll do? You just sublease. Okay. In such a case, you pass this journal entry NIL. You pass the journal entry NIL to what? NIL to ROU asset gain or loss to SOPL. So sale and leaseback, there are no serious questions in sale and leaseback. Sale and leaseback, what we have, sale and leaseback, what is to be done is, sale and leaseback, sublease. There are no serious questions in sublease. Just is it operating lease, is it finance lease? To identify a sublease, so these are the questions in sublease. So there is a asset which useful life is 40 years. Which we have originally leased for 5 years and leased out for 3 years. So is sublease a operating lease or finance lease? This is sublease. Operating lease. Now they are telling you used for 2 years and then leased out for 3 years. You used for year 1, year 2, then year 3, 4, 5 is what you subleased. You already used it for 2 years and then subleased. Then is it an operating lease or finance lease? Then still it is no. Then it is finance lease because original ROU right is for 5 years and 2 years you already used. So remaining life is only 3 years. You leased out for 3 years, 3 out of 3, 100%. So it is finance lease. Don't compare to identify operating lease or finance lease of sublease. Don't compare 40 years I have leased out for 5 years, 5 years I have subleased. So don't compare 5 out of 40, you should compare 5 out of this 5. Okay. So that kind of questions only you have, not a serious accounting kind of question. So now I have a serious area, sale and leaseback. Sale and leaseback is a very, very important area. Sale and leaseback. So what is given here in sale and leaseback? So here the owner of the asset is selling to a owner who turned to seller, sold the asset to in need of funds, sold the asset to lessor and then leased it back and get the characteristic of lessee. So now we call it as seller has become lessee and the buyer is the lessor. So what is the accounting in case of sale and leaseback in the books of buyer, lessor and seller lessee? Okay. So we are doing IND AS 116 sale and leaseback accounting. In sale and leaseback accounting, my first point is whether the control is transferred as per IND AS 115. Then only we can call it as sale. Sale means I transferred control and then leasing it back. Control is with buyer, then leasing it back. Sale and leaseback happened and the control is transferred to buyer. Okay, is control transferred? Yes, control is transferred. Then this is the journal entry. What entry? Entry is sale bank account debit to asset. You derecognize, always asset is derecognized at what value? Carrying value. Then because it is leased back, you take the compute lease liability, present value of future payments. Is lease liability now recognize ROU asset? So ROU asset value will be equal to lease liability? No. The very first time lease liability ROU asset, lease liability's value is assumed as ROU asset's value? No. ROU asset's value is equal to carrying value. This carrying value into proportion leased back. How much proportion you leased back? Carrying value, this is 100% carrying value into proportion leased back should come as asset. Gain or loss to P&L. Okay. Now, if control is not transferred, accounted as per 115. Yesterday we studied sale and repurchase arrangements. the amount received will be recorded as liability. Sale and lease back alla sale and repurchase. So sale and lease back, there should be sale. Then only lease back is having some relevance. Sale means control is transferred. So here, only if control is transferred, this area is applicable. If control is not transferred, it is like repurchase arrangements, which will be recorded as a liability first. Then repayment more or less accordingly you will do. Okay. Now what is the accounting in the books of seller lessee? What is the accounting in the books of seller lessee? So where we have these three areas in the books of seller lessee. In the books of I leased it back. In my books, if selling price is equal to fair value, selling price is equal to fair value, a genuine transaction, then ROU asset is equal to carrying value into proportion. That proportion is lease liability divided by fair value. And if I have taken over 100% capacity of that asset, if I've taken over 100% of that asset, 100% capacity, 100% of full capacity, if I have leased back, then lease liability present value will be minimum equal to its fair value. Yes or no? മനസ്സിലായില്ല. അതായത് ഇന്ന് 15 lakhs into ഒരു asset. If I have leased back in its 100% capacity, then the present value of lease liability will be equal to 15 lakhs because I need to pay for that asset plus delayed payment interest. I need to pay 15 lakhs itself. So how much proportion you have taken over means present value of lease liability divided by fair value is the proportion you have taken back. Okay, I didn't understand. Okay, so shall we take one last question? Last question for the day. So this is our study material illustration number 45. Okay, an entity seller lessee enters into the entity seller lessee sells a building to another entity buyer lessor for cash 30 lakhs. Sold a building for 30 lakhs. Okay, this is the selling price. Immediately before the transaction, the building is carried at cost 15 lakhs. Okay. At the same time, seller lessee enters into contract with buyer lessor for the right to use the building for 20 years with annual payments of 2 lakhs. Okay. The terms control is transferred. Okay. The fair value of the building on that date is 27 lakhs. Oh, fair value is only 27 lakhs, but you got how much? 30 lakhs. Any initial direct cost ഒന്നുമില്ല. Interest rate implicit in the lease is 12%. This is an operating lease for buyer lessor. How this will be accounted if present value factor at 12% for present value annuity at 12% for 20 years is 7.47. How this is to be accounted. Okay, so here what I'll do is we'll in class also we'll do this as 3 cases. What 3 cases? First we'll see if it is case number 1. Case number 1. What is case number 1? Sale price is equal to fair value, which is equal to what if I've taken only 27 lakhs? 27 lakhs. If my selling price is only 27 lakhs, then what will be the entry? What will be the entry? Bank account 27 to asset. Carrying value, do you remember? To lease liability. You need to pay 2 lakhs for 20 years. So they have given the annuity factor 7.47. 7.47. Lease liability is 2 lakhs into 14 lakh 94,000. Now I'll calculate what is the proportion taken back, proportion leased back. That is 14 lakh 94,000 is the lease liability. But what is the fair value of the asset? 27 lakhs. Now 27 lakhs is the value of asset, but you leased back and lease liability is only 14 lakh 94 means the proportion you have taken is only 55 point. Full capacity you have not leased back. If you have taken the full capacity of the building, then you should minimum the amount of lease liability will be 27 lakhs. Minimum lease liability you need to pay is 27 lakhs plus interest. Present value is only 14 lakh 94 means 55.33%. So here ROU asset is 15 lakhs into 55.33%. 8,29,950. So 27 lakhs. From where did you get this P&L? Balancing figure. Only balancing figure, not just balancing figure. If selling price is 27 lakhs, cost is 15 lakhs, your profit is 12 lakhs. Yeah. Of which 55.33% you leased back. Came back. So what is gone forever? Balance is the profit which you can recognize. How much it is coming to? 5,36,045. 90 rupees difference. That's okay. This comes to 5,36,040. Here there is a rupees 90 difference. It's fine. Done. If selling price is more than fair value, that is 30 lakhs is the selling price, but fair value is only 27 lakhs, then difference is equal to additional loan, additional financing given by lessor to support lessee. For asset, for lease, for the sale of asset, how much amount only required to pay by the lessor to lessee upon sale? Upon sale of asset, the amount to be paid is only 27 lakhs. But you paid 30 lakhs. Considering substance over form, 3 lakhs is an additional loan. Are you getting? So the entry should be bank account debit 30 lakhs. Okay. To asset credit 15 lakhs. To lease liability and to financial liability loan. How much is loan? 3 lakhs. Oh, loan is 3 lakhs. Yes. Only when the market rate different, actual rate difference, you take present value of remaining outflows. But otherwise 3 lakhs. Lease liability will be 11 lakh 94,000. Why 11 lakh 94,000? Because 2 lakhs into 7.47 is the payment to be paid, to be made, correct. Of which 3 lakhs is towards other loan. Balance 11 lakh 94,000 is lease liability. Okay. So how much is the ROU asset to be debited? ROU asset to be debited is proportion is 11 lakh 94,000 divided by 27 lakhs. 44.22%. So it is 15 lakhs into 44.22. 6,63,300. The 6,69,300. How will I tally? That is 27 lakhs is the sale price, no doubt. 15 lakhs is the carrying value. So 12 lakhs is the profit from the asset. In minus 44.22% is leased back. So 12 lakhs minus 44.22%. 6,69,000. Are you doing this? So what is the further accounting, subsequent accounting? No further accounting for bank. ROU asset will be depreciated. Asset gone from the books. P&L gone. Profits. What about lease liability and loan? Amortization table. Okay. So 2 lakhs is the total repayment for it. Yes. How much towards loan repayment? How much towards lease repayment? You allocate in this ratio. 2 lakhs into 1194 divided by 1494. 1 lakh. അല്ലല്ല തിരിഞ്ഞുപോയി ഇത് ലീസ് ആണല്ലോ അല്ലെ this is lease, this is loan, this is lease and this is loan. So 1,59,839 is lease repayment and 40,161 will be considered as in the amortization table. Amortization table repayment. The absence of information from the students, I assume it is clear for everyone. Now, what is the other one? Last one. Last one is what? Last one is if our answer to this question is idana. Answer to this question is this part. This is the answer to this particular question. But we are doing what if sale price is less than fair value? What if sale price is less than fair value? What if sale price is less than fair value? Sale price is 25 lakhs and fair value is 27 lakhs. It should be treated as prepayment of lease payments. What? That is, we'll do like this. Bank account debit. We got 27 lakhs. But 25 selling price, but we'll take 27 lakhs. To asset we'll credit 15 lakhs. And we prepaid 2 lakhs. Lease rentals. To lease liability, any further to be paid is 14,94,000. So how much is ROU asset? Prepaid. 2 lakhs is prepaid. So ROU asset is 16,94,000 divided by 27 lakhs. 2 lakh plus 14,94,000 divided by 27 lakhs. 62.74%. So it is 15 lakhs into 62.74%, 9,41,162.74 to P&L. Please have a look. Please be clear.